Today, the bank held a meeting to consider the appropriate monetary policy stance and taking into consideration relevant global, regional, and domestic economic factors, as well as the price and financial stability mandate, decided to maintain the discount rate at 6.75%. The decision is based on a cautious approach and the need to understand how the Middle East crisis and oil price shock will impact the domestic economy going forward and for how long. On the global front, the IMF has revised down its global growth forecast, citing heightened uncertainty driven largely by geopolitical tensions. In particular, the ongoing war in the Middle East is expected to weigh heavily on global economic activity, disrupting trade flows and fueling inflationary pressures. Inflation is slowly picking up, driven by surging oil and gas prices. Second-round effects are expected to put further pressure on inflation. Policy rates are broadly steady in major central banks, applying caution considering the ongoing global uncertainties which may worsen inflationary pressures. Eswatini's annual headline consumer inflation rebounded to 2% in April relative to 1.6% in March, driven by housing and utilities and transport. The bank revised up its short to medium term inflation forecast to 3.31% from 3.27% forecasted in March, primarily on account of the ongoing geopolitical tensions. Credit extended to the private sector increased by 0.9% month on month to a total of 23.2 billion in March 2026. Non-performing loans in the banking sector fell by 0.3% month on month to close at 1.4 billion at the end of March 2026, representing an NPL ratio of 6.8%. As of 22 May 2026, the reserves stood at 8.8 billion, equivalent to 2 months of import cover. Preliminary figures indicate that total public debt stood at 40.6 billion, which is 38.9% of GDP. The direction of monetary policy will continue to be driven by the assessment of risks and uncertainties in international, regional, and the domestic economy. I thank you.